Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Chief Investment Officer.
Matt Mondoux, Senior Financial Advisor.
And Dan Seder, Managing Partner.
So, has been a very eventful start to the year. And I would say it's been a little bit outside of the ordinary because we've had a few very big thematic things playing out. The first being artificial intelligence and how that's rippled its way through financial markets. We'll talk about that a little bit. But then also some of the conflict in the Middle East. You know, what has that done to not just geopolitical relations, but then what has it done to financial markets? We'll talk about that with regards to the bond market and inflation, whether or not we see some potential stickiness. And then we'll close out with why June could end up being one of the bigger tests for the market that we've seen over the last couple of years. So just to kick things off, I think it's easy to continue talking about artificial intelligence just because of not just how much it's in the headlines, but just how rapid the development has been. So I think right now, at least, the most important story is centered around artificial intelligence spending. So I think investors have really become pretty accustomed to strong artificial intelligence demand. But as we look out, or I guess we look back over the last 2 to 4 weeks, you've seen the narrative broadening quite a bit in terms of it's not just NVIDIA, it's not just Microsoft, some of your stalwarts, but really within the chip space, looking at companies that provide memory chips, or you look at a company like Nokia that was this old school cell phone provider that all of a sudden has become a key player in artificial intelligence deployment. You know, it has been a very, very interesting dynamic to watch this narrative develop. So it's not just the chips, it's also the power infrastructure players, data center infrastructure players, your picks and shovels type folks. So the big thing here is that the market is effectively betting that AI spending will continue to be one of the strongest investment cycles in decades.
So, Daniel, if the bull case is that this will continue, I guess you have to think of it in terms of what's being priced in today. And stocks in this segment are relatively rich in terms of valuation. So valuations have gone up, and they're not considered cheap at this point, even though there's a really strong prospect for earnings growth moving forward. But maybe just some feedback on what if the infrastructure spending here slowed down? What if it doesn't continue at the pace that we've seen? Is there any risk that valuations are too high and there could be a pullback?
I think that's the biggest question that we can't answer just yet. The biggest question being, what happens if demand doesn't come to fruition as is currently being expected? Meaning, how do these large language model providers monetize, at the enterprise level? What if they can't make as much money as initially expected?
Yeah, look, we've talked about this, right? So Google came to dominate 98% of search, right? So they had a monopoly effectively in internet search. What if this model's different? So we don't know what the business model is. We could have 3 players in AI. It could become more of a utility. Margins are lower.
Yeah.
That is dramatically different outcome.
Precisely. And so to me, I would make the argument that yes, in certain pockets of this artificial intelligence narrative, you do see valuations that are pretty stretched and are ultimately, they could potentially be pricing for a perfect scenario, a perfect world that doesn't end up existing.
I saw a headline. It was predicting that the AI boom is 50 times larger than the internet boom, or could be. And those types of numbers, I think, really put it into perspective. I mean, this will change, but it's not just AI. It's the knockdown effect that it has on other businesses and margins falling to the bottom line. More companies are more efficient. Really, what's fascinating to me is going to be the story that plays out on how it impacts jobs, which will ultimately impact consumer spending.
Yeah. I mean, look, we have some fairly encouraging proof points at this juncture. An easy one to talk about is Anthropic, creator and provider of Claude, private company still planning to go public later this year. Their quarter-over-quarter revenue increase from the first quarter of 2026 to what they're expecting for the second quarter of 2026 is just north of 130%. That's quarter over quarter, not the second quarter of 26 looking back over to last year. That's just one quarter. That's a larger figure than Zoom did in the heart of the pandemic in 2020. So the proof point right now is that the adoption is good. Anthropic is monetizing right now, but are there securities in public markets that are extrapolating that level of demand growth in perpetuity? In certain segments, yes. In other areas, for example, if you go up the supply chain and think about power generation, they don't have the risk of demand monetization. The people that need the power have to pay for it up front. So your GE Vernovas, your Quanta Services, some of your small modular reactor and alternative energy plays, they might be trading at a lofty valuation relative to history, but that's because they've got demand booked out 2-3 years. So there are elevated valuations. I take more issue with it in certain parts of that economy than I do with others.
Maybe this would be a good segue, but the contrarian in me, or the skeptic in me, says, well, we're gonna have all these IPOs this summer. OpenAI, SpaceX, which has XAI, and Anthropic might all IPO. Near term kind of reminds me of when UWM and Rocket IPO'd right at the interest rate bottom.
Right. Yeah, I think, look, entirely separate conversation around some of these massive IPOs that are slated for the back half of this year. But, I think the common notion of the getting's good, I do think applies here.
Yeah.
On the flip side, even though we've seen a pretty meaningful run, at least in U.S. equities over the last two months or so, you've had the bond market behaving pretty interestingly. And I would argue that, it is kind of, or at least it has been flashing a yellow warning light. So specifically, if we look back pretty much since the start of the conflict between the U.S. and Iran, you've had Treasury yields rising across the curve. And it's been fairly stark at certain points. You had the 10-year Treasury hitting a one-year high close to 4.6%. You had the 30-year Treasury that moved above 5% in the secondary market for the first time since 2007. And these are clearly levels that make investors pay attention. I think if I could just sum it up into one thing that is the reason behind this happening, sticky inflation. People, investors, and the general public are very concerned about sticky inflation on the back of higher oil and energy prices. I think that right now it continues to be a concern, and it will be a concern until we get some absolute resolution between the U.S. and Iran, and thus, a little bit of resolve in oil prices. Have seen it a little bit more recently. But still, if you look at consumer sentiment, from the University of Michigan, that's that survey they put out every month, consumers have never felt worse, quite literally, in the history of this survey, and they are pricing out inflation expectations north of 4.5% in the medium term.
Yeah, and this is I think from a consumer standpoint, this is a big bummer, right? I mean, you look at oil prices on top of food prices. Inflation's really dominated the news cycle more or less since, the pandemic. It's been really interesting. Mortgage rates that we had grown accustomed to 2, 3, 4% mortgage rates. Now we're 5-6%. That makes housing affordability that much tougher. So inflation does become a problem. It is. It's a headwind. Consumer spending still remains decent. And I guess when you look at it, a lot of the data doesn't really care if you're spending at Nordstrom's or if you're buying gas at BP. But at the end of the day, it does eat, out of, people's pocketbooks. It makes housing is the big one, housing affordability, housing turnover. So these, the economy will hopefully, be able to adjust. And like you said, I think if we get some relief on oil, energy, that would go a long way. But yeah, when you're just going to start to flow, the longer this goes, the longer it'll flow through to, producer prices, to, just creating everything being more expensive.
Right. And I think that's essentially it, right? If we get a more absolute resolution within the next 2 weeks, I think this all becomes ultimately a blip on the radar. Even though you might have CPI or PCE, whatever your preferred inflation gauge is, coming in a little bit elevated on a year-over-year basis over the next few months, realistically, as there's an end in sight, I think consumers have a lot less challenges to spend, and that's where your whole sticky inflation narrative kind of falls apart. Now, maybe one secondary interesting observation that I have on the back of broadly higher rates across the U.S. Treasury curve is that, generally speaking, when you get that fairly meaningful move upward in interest rates, there's a negative correlation between that upward move in rates and what happens in the stock market for certain segments. Well, in this case, when I think about what segments that those are, it's firms that trade at a high valuation are usually going to be pretty sensitive to rising yields, meaning, let's just call a spade. Places like the tech sector, usually rising rates are not super productive for equity investments in tech. That has not been the case this go around. You've seen tech stocks rising in lockstep with yields. So that's maybe just an interesting point to call out. It's not to say that, this would be cause for a bottom falling out of the tech sector. I think that what investors are more paying attention to is not the discounted cash flow Excel plug and more paying attention to the actual results, the underlying growth, what we've seen put forth, at least through the first quarter. But I think it's just one important call out that, to see tech being very correlated with interest rates is not something we generally see.
And I'm sure there's a bit of FOMO in there as well. This is a pretty unique market. But I will say, when you look at sentiment, overall, it's not terribly strong. So we're not at that euphoric state where you start to worry about the dreaded B word bubble. According to most sentiment surveys, still people are more bearish than bullish.
Right, that's correct. And, maybe just switching gears, albeit briefly, just to talk about the actual conflict between U.S. and Iran and not just, one of the major byproducts being inflation. The biggest developments we've seen in the last 2 weeks, I think, have been, at least for me, to have some level of confidence instilled that we are mostly through this conflict. You have essentially the two parties at the goal line, and it's just a matter of some of the minutia right now. So even though markets started to price this in essentially at the beginning of April, now you're starting to see some real resolution and very productive talks between the two parties, which is why I think investors have been able to rationalize continued support for equity markets. Now, this does open up the financial markets in general to potential for downside if you were to get a unforeseen collapse in negotiations. Again, I don't see that happening at this juncture. The commentary that we've gotten from both sides is, again, very much related to the minutia. So I think that some of the optimism that you've seen, whether it's a bit of a reprieve in bond yields over the last week or continued upside in some of your chip stocks, I do think that some of it's founded. But it's just worth being aware of, a 60-day ceasefire, for example, which is essentially what's currently tentatively agreed upon right now, doesn't solve the entire issue, because if the Strait of Hormuz gets closed again in 60 days, we're kind of back to square one, and that sticky inflation narrative regains some ground. Yields head higher, oil prices higher, stocks ultimately look more expensive.
Yeah. It's. I mean, this is going to be a tough one to control. Ultimately, the world is aware of how important this strait is. This is, I think a lot of people knew, but never knew exactly how much significance and how much this could drive inflation in the U.S.
Yeah. And, okay, so last topic, and this is going to be trying to put everything together, but June, as we record this on the 1st of June, 2026, it could end up being a pretty big test for the market. And the reason for that is because, as I mentioned before, off of the bottom, peak pessimism of the conflict between U.S. and Iran, pretty much since the first day of April, the market has enjoyed a pretty extraordinary run. You have major U.S. indexes reaching record highs. I would say, pretty broad-based participation from lows, but really it's been dominated by the tech stack. And you do see some evidence of investors just, abiding by that buy the dip mentality. What I would say is the reason that June ends up being important, you've got a ton of different things that are now converging. Employment data, this has been a continued question for the last year. Inflation, are we going to see stickiness, or are we going to see inflationary figures bleed into other areas outside of gas? You've got a Federal Reserve that has a new chairperson. You have earnings that blew out expectations in the first quarter. Can that momentum be maintained, or are expectations now going to be all the higher? And then, of course, you have commentary around the Middle East. So you've got a lot of events and a lot of different pieces of the puzzle that are starting to converge. So this crossroads that we're at right now, although there has been fundamental support for what the market has done, I think that there is a fairly complex equation that's going to have some variables solved for in the month of June.
Daniel, I think about something like seasonality that typically sell in May and go away is the seasonal trend where from May through the end of October, the market is generally weak. From November through the end of April, the market is seasonally strong. And we saw the S&P up over 3% in the month of May. That's a big move in 1 month, particularly a seasonally weak month. You see tech thriving when rates are going higher, which is uncommon. To me, I think these are the signals. The signals when the market is moving contrary to what could be a seasonal trend or a fundamental trend or correlation between rates and tech. It would be, we have corporate earnings that have been tremendously strong. How much of anything, any flop in employment data or inflation data or developments in the Middle East can the corporate earnings cover up? At the end of the day, earnings drive price. And if earnings continue to move at the pace at which they're moving, I wouldn't be surprised if price follows. And if price follows contrary to some of these other trends, that to me, that's the signal. Extraordinarily bullish. That's a bullish signal.
Yeah, I would agree with you. And the only counterpoint I have is that I think that some of the headline index figures for the month of May are masking what's actually going on underneath the surface.
Because of tech.
Right. And so I think a lot of people would be surprised to hear that on a cap-weighted basis, if you looked at, instead of the S&P 500 index level return, if you looked at the 11 GIC sectors within that index, only 3 of them were positive. So tech was very positive. And then you had consumer discretionary and healthcare that were positive, but below the index level return. Your other 8 GIC sectors were actually in negative territory for the month of May. So on one hand, that's a bit concerning. But on the other hand, I could make the argument that how do you talk about overvaluation at this juncture in anywhere outside of potentially 3 sectors and not talk about it, a month ago for the rest of the equity market, right?
It's a good point.
So I just think that, and by the way, if you looked at this on an equal weighted basis, meaning, every stock in the S&P 500 gets an equal allocation within the index and it's not 30% tech, it was a similar kind of experience where tech was up 20-something%. And I think there was, I'll have to fact check this, but there was 4 sectors that were positive, I think, instead of 3, but same kind of experience. So it's not like it's just the cap weighted methodology that's skewing results. It's really just that the tech sector has been fueled by optimism, and that's what's fueling index level returns. So I do think there is room for a return to what we saw for the first 3 months of this year, and that was a broader set of returns. The equal-weighted S&P outperformed the cap-weighted S&P meaningfully in the first quarter, and that to me is always going to be indicative of a healthier market. So even though some of the optimism around conflict resolution and earnings prints has kind of dominated what investors have priced into the market, I think one piece of optimism I have is that there is a potential for return to broader returns. And to me, it just does point to need for selectivity. And, that just when you get to a juncture like this with so many different factors that are coming into play, I think you have to be very astutely aware of what you own and why you own it.
Awesome breakdown.
All right, everybody. Just to recap, talked at length about narratives in AI, talked a bit about an expansion of what's going on in the bond market, where we could see some sticky inflation, where we might see a resolution, and then put it all together with why June could end up being a pretty big test for financial markets. So thank you all for tuning in to another episode of Blue Chip Now, as always, and we look forward to speaking with you again soon.